In this video, I'm going to be running you through this trade. I'm going to present to you the different price action concepts I used to find this position and how I managed to take advantage of it to make a nice return on this account in a very short period of time. So with that said, let's get to the learning. Now the position that we're going to be covering in today's video was a pure low time frame trade. It was executed, managed, and closed within the space of around 1 hour. So it was a very quick in and out position. And there are two core concepts that this trade revolves around. They are liquidity and momentum. So the first thing to note with it being a low time frame trade is that we don't really need to have a high time frame narrative around this position. See, because we're moving just off of the liquidity and different levels that we expect to see liquidated, the highest time frame we really need to look at here is the 30-minute. And what we have here is the high of the previous day and the low of the previous day marked out. So this formulates a bit of a trading range. Now, generally, when we see the highs and the lows of previous days, these levels are quite often swept, meaning if the market is trading here, we are likely to see at some point the market sweep the liquidity above this high before coming down to trade back into the lows of the range. So that was kind of the first thing that I had in mind for this position. Now, another thing that we can see from exactly where we are is that we've got a small collection of equal high liquidity. So to that liquidity point we just spoke about, when we have a level that acts as a clear resistance, such as this, that the market is retesting multiple times, this is an area that actually acts as a magnet for price, because what do we know? Well, if there's sellers at this level acting as resistance, there's going to be a collection of stop losses just here. There's also going to be a collection of breakout trades. Markets react to orders. They are pulling into areas where orders are waiting to fill those orders, and then new reactions form. So with this high, obviously having orders above being the previous day's high, so there will be some form of breakout trades and stop losses in this area. We have an area of liquidity just above this high. Then with the triple equal high area we have here, there's more liquidity between this point. So pretty much this whole area in the high up here becomes quite a high probability magnet for price because the market is likely to come and fill into these orders at some point soon. Being that high of day liquidity, we can expect that with the current structure of the market pointing to the upside, indicated by the continual formation of higher highs and higher lows, it's quite likely we're going to come and trade into this point today. And that pretty much builds the foundation for the setup. I have an idea that we have a collection of liquidity up in these highs. The market at the moment is actually forming a bullish trend. As we can see from this low, we have a higher high, higher low, higher high, now potentially forming a higher low. So with the trending structure pointing to the upside and with the liquidity up here, this magnet area looks like an attractive place for me to trade through into if I get opportunity to do that. Now, what else can we see here on the 30-minute time frame? Well, we have a demand zone, which is this demand just here. We have this last candle before the impulse. This was a high probability, high interest buying area previously. So when the market comes back into a point like this, I would expect to start seeing the market pick up once again. So with this kind of medium time frame narrative where we are looking at a magnet sitting up here, we have liquidity which is likely to be swept. And then of course, the high interest demand area being retested in this small uptrending phase, we have pretty good grounds to believe if we can find an execution, a safe trade would be a buy through to tackle the liquidity up here. Now we've taken a step down to the 2-minute time frame. Remember, this is an intraday trade. So for these positions, I'm going to be using considerably lower time frames than if I was in a swing trading setting. So the 2-minute and the 1-minute are in use on this trade, primarily the 2. We're going to see that now. So here we're looking at the scaled in range. We have the triple equal high liquidity, which is the 1, 2, 3 pushes at the high just here. This forms the high of London session. So with this triple equal high and London high being situated at this level, this becomes a nice clear target for us. Now what we can also see is that the market has swept the low of this range just here. We had a push under the range and then we had a push back into the range and a push over this high, which we could indicate as a break of structure, but I noted that we had pretty much 2 equal highs here. So rather than placing a buy order down in this low, I figured what we could do in this instance, due to the fact that this is a sweep of liquidity and could be followed through with a larger pushback to the downside, is I decided, rather than actually placing a buy order here, we'll wait to see how the market reacts within this demand area at this low. And then if we get a nice solid reaction, we can look to join the trend on its way back up. So then I would be looking for a movement like this. Now, if we step the market forward a little bit, you'll see that what happened instead is that we had a small sweep of this low. And this is why I opted not to go for a buy limit. Because we had this equal high liquidity swept, we often see the market sweep liquidity back and forth as we've already covered. So I understood, with liquidity being swept here, it's possible that we sweep this low once again. Another thing is that although I had this bias to potentially buy back into these highs, I don't of course want to gamble into that. So I need to see some meaningful shifts in the trend for me to do that. Now, if we consider this break under the low of the range, yes, it looks like a liquidation because after breaking the range, we had this big rally up. But this could potentially have been the opening into a new downtrend. So I don't want to just buy directly into that without first seeing the momentum picking back up in favor of our position. So then the market came down and swept this low just about. Now, what I really liked about this position, having seen the sweep of this low, is the market attempted multiple times to push down under this level. But what do we see? Well, we see a total failure by the market, even on a time frame as low as the 2-minute. We see a total failure to close beneath that level. So you can see every time we punch below this level, we sweep and then we push back and close back above. And we can see now the wicks on the top of these movements are small, but the wicks on the bottom are large, and this shows considerable buying pressure coming in at this level. So this low that we printed here after sweeping this liquidity is essentially validated at this point because we're now seeing that this low is managing to hold and the market price is failing to go below this level, which is of course an incredibly good sign to see if we are looking for a trade. After that, we started to see this nice bullish push to the upside, and this was giving me what I wanted to see in order to get into a position. And another thing worth noting here is the 1-minute and 2-minute structure. So taking a look just at this small area in the market, we can see we had a lower low just here. The market came and formed a lower high. Then we had another lower low. As you can see, this low is lower than the previous ones. Then we had a push up, which formulated a higher high. Now, this is, of course, low time frame structure, but we are looking for low time frame structure. So what we saw here was a break in this 1-minute trend. And of course, with the momentum factors that we just considered, the market totally failed to close under this low. And each of these large wicks and this drive that we've seen is showing us that a lot of buying pressure is coming in under this low. So we're starting to see the buying momentum that we want to see. And now the doors are essentially open to the upside target that we wanted to see. So what we could do in an instance like this is begin placing buy orders. We could actually mark out demand, which would be around this point here. And then we could place a buy if the market came back into this level. Now, I personally didn't do that. I waited for kind of a secondary confirmation to back up my trade and make sure that I wasn't buying in at the lows. With this being a liquidity focused trade, with this being on the 1-minute and 2-minute timeframes, there's going to be a lot of noise. So we need to be careful about our entries, make sure we've got all the confirmation that we want to see to be comfortable getting in and holding the position. So now scaled into the low timeframes, we can see here that we've had a pullback down, trade into that demand, and then we pushed away. And this push away is what we call an efficient range. So there are two phases in the market. We have market inefficiency and market efficiency. An inefficient market is a market where we have a big drive down, which is not retested. So a big open price range. For example, when we formulated this movement here, this left a market inefficiency. An efficient market is when every single demand or supply zone that forms gets a clean retest. And we can see in this example that we have demand, push away, pullback, retest. Then we formulate new demand, we have a push away, a pullback, and a retest. So every time we formed a demand and then traded away from it, we came back and retested that demand comfortably. Essentially like stepping upwards. Now, an efficient range is good to see because this shows us the market is respecting the orders and moving in a clean flow of orders. With the market then coming up to tackle these highs for a 1 to 3rd time here, I start to see that the market is definitely looking to take on these highs. Now, every time the market trades towards a high or a low level, that level gets weaker because that tells us that the market is continually attempting to push against that level. And while it's been rejected so far, if it continues to push at the level, it shows there's a lot of momentum pushing towards that point, and it's unlikely to hold for a very long time. So now, in terms of the trade thesis, we have a sweep of this low, failure to close below, buying pressure coming in and kicking in and pushing the market up. We had this change in the 1-minute trend at this point. Now we've had a clean demand retest followed by an efficient market range, which is now pushing at a high for the 3rd time, indicating to me that this is going to be a weak high and will give way to the market soon. So at this point, I'm happy to execute a trade. So my personal position was executed at 1.06374. My stop loss was at 1.06340, which is just there. Now, why was my stop here and not under the low? Well, the theory that I had here was, because we're in an efficient range, and this is another way that these efficient markets can become useful, there is no reason for us to trade back down into this low unless I'm incorrect about the trade. In fact, that does mean that I could have actually scaled the stop in to pretty much just under this low here. So I could have had a stop loss pretty much at 345 quite comfortably, which would have been less than 3 pips. Now, to be honest, because the majority of the trading accounts I use are 1 to 30 leverage, 3.5 pips maxes out the margin I have available anyway, just to risk 1%. So there was not really much point me bringing the stop loss any smaller, as I have that leverage restriction that won't allow me to get the full 1% risk on if I bring the stop lower. So the trade so far, we have an entry from just up here as we tackle these highs for the third time. We have a stop loss below the efficient range here because there's no reason the market should get down there unless I'm wrong about the position, in which case I'd rather be stopped out and get out the trade. And then targets wise, well, you already know where the targets are going to go. Those targets are pushing for this high, which is the triple equal high level, 1, 2, 3, the high of London session, where the market is formulating a lot of liquidity. We can expect to see this range filled before we lead into either sweeping the previous daily high or reversing from this high. Regardless of the outcome then, we will be out of the trade, so we can just happily look for this push up to follow this new forming momentum, get out of our position and be done for the day. Now, upon zooming out to see the full range here, you can see that this trade is becoming attractive. We had a lot of selling momentum coming from this point. That was quickly followed by some bullish momentum, and then some weaker selling momentum, followed by a total death of the selling momentum, where instead of seeing these strong selling movements, we are seeing nothing but sideways ranging price action that has started to push back to the upside. And the significant wicks we're seeing on the downside and continual attacks of this same level here show us that this momentum is really picking up from the buyer's perspective, and we are actually starting to see the battle shift from selling control into buying control. So the overall return for this trade was 3.38R from my exact execution, stop loss and target. I'll post the screenshot from when I first got into the trade just here somewhere so you can see that. And now let's allow the market to play out. So we started to get a very nice push towards our targets. Now, at some point on the way up, around here, I believe, we did start to stall out. So we saw a little bit of resistance from the supply zone just here. And for this reason, I ended up closing some of my trade at around this point. I closed up around 1% just there. And then if the trade had filled the rest of the target, the remainder of position I'd be holding would have been a 1.6R position. So that is why I got around 2.67% out of this trade, because I was preparing myself for if the trade doesn't want to continue, I'd rather be out. So at this point, I've got two things in mind. I am out of some of the position for minimum 1% in profit, and I have my stops rolled to break even. So at this point now, I have no risk left on this trade. If the market decides to come back to entry, I'm out for plus 1%, which is obviously a positive outcome. And if the market does continue up towards the target, well, then I'll be out for the full 2.67. And this market did play around for some time. It didn't drive directly towards my targets as I'd have wanted it to, but it didn't take too long for the market to start picking up once again, after making a small pullback and sweeping this low. And then after a little bit of fuss, we did start to move towards the targets. And as you can see, we kind of formulated that same price action again on the way up, where we had this high, we tackled this high again, the third tap of this high, the third push towards that high. What did we say? Every time we attack a level, it gets weaker. And it was the third time that was able to break through, form that solid closure, and trade me through towards my target to close out this trade for the total of 2.67% on my account. And as we said, from this point onwards, we were at a risk-free outcome. The least we can do is win 1%. The most we can do is turn it up to 2.67. And you will see just after we swept this high, we did indeed start to get a nice bit of selling movement. That is because we've swept the liquidity above this high. And what does that mean? Well, after a sweep of liquidity, we very often move the other way to start tackling new areas of liquidity. So here's the position when it was finalized. And here's that exact same position in my MetaTrader account. And here's the profits that I made from that position. Now, there's one more thing that I want to cover in this video, because obviously anyone can win an individual trade. So what I want to do is show you some of my results from the past 3 months so that you can see this is not just a fluke, and these are consistently profitable trades that you can be taking to create a career in trading. What we can see is a 16.2% return, so a 16% profit, with a 1.85% maximum drawdown. Meaning, in order to make that 16%, I never even exceeded 2% in drawdown, highlighting the safety and effectiveness of the system that you've just looked at. Now, in generating the 16% profit, I've only been right just over half the time. 53% is the win rate for this account over the past 3 months. And as you can see by looking at the average loss versus the average win, we're trading with around a 5.85 average risk versus reward ratio. meaning when we win generally 5.8 times more than we lose when a trade goes bad. And all of this is equated to an 8.75% return factor, meaning I've made 8.75 times the maximum that I've lost. So I've made 16.2% for a total risk or loss of only 1.85%, not even 2% drawdown. And my ability to keep drawdown to an absolute minimum leaves me with a less than 0.01% risk of ruin. So when we look at the statistics altogether, there is less than a 0.01% chance that I get into even 10% drawdown on this account. And this is why I want to point out how important it is to get real with your trading if you want to trade full time. Now, right now, you might be chasing 10%, 20% daily returns, or even just monthly returns, but you're probably having swings of 5 or 10% quite regularly. Now, there is literally a 1 in 10,000 chance that I go 10% into drawdown with the way that I trade. So you hitting 10% swings up and down every week is really not good for a long-term sustainable trading career. You want to have dialed in, consistent small returns with absolutely controlled losses that really cannot get out of hand, even if they really tried to. And I want to emphasize that you do not need wild returns in order to trade successfully. I want to highlight the math on a 16% return, just so you can see how effective this is and how easy it is to turn this kind of trading into a full-time career if you get realistic with trading, ignore all the bullshitters, and focus on reality. With a $100,000 account, if you had made a 16.2% return like I have over the past 3 months, you would make $16,200. Now already that's probably beating what you make in a job in 3 months. But let's turn it up a notch, because you probably don't just have one account, or you don't have to settle with one account with the amount of funding that's available nowadays. So if you were to double the funding you had, you would have $32,400 in profit from the very same percentage return. And as you can see, if you jumped it up again to $500,000 in funding, you'd be taking home $81,000, which is over $20,000 per month over this time span. And the thing is, you can get this capital. Now, if you've not heard of prop firms yet, you might be thinking, how on earth am I supposed to get all this money? Well, the reality is there's firms now that will give you money to trade with if you can prove consistency. And if you can trade how I can trade, you can immediately prove consistency, get access to this capital, trade it, make profits, and get paid out. This is the path that I take my traders down. And this is from just the last week alone. This is another 3 people funded, meaning a few $100,000 more that these traders will be able to trade with, profit with, and keep the money that they make. Trading is not about making huge returns every single day or every single week. I've just showed you that 16% can be a huge profit. So I want you to take that information, stop trying to do these crazy account flips, put an end to the huge 5 or 10% swings that you're seeing on your account every week, take trading back to reality, and understand that you can make small percentage profits, and that will turn into huge dollar profits. You don't need massive percentages to make massive amounts of money. And thanks to prop firms, you don't even need to have the money to invest in the first place. I always try and push this realistic outlook on trading to my students, and here's just a view of some of the profits they've made using my strategies this year. Now, if you're feeling a bit lost in the chaos of trading, it seems impossible, then I can help you bring trading back to reality a bit and set you up to actually start profiting without all of the stress, without the BS, without 10-hour chart days, and without promising you lies like you're going to flip your tiny account into hundreds of thousands. What I can do is give you a realistic way to trade the markets and make a realistic amount of profits to build a thriving, stress-free, full-time trading career. Now, if you want to learn more about that, hit the link in the description and I'll take you on board, teach you everything I know and everything that you need to know to build a prosperous trading career. So I hope you've enjoyed this video. I hope you learned something from the analysis. I hope you learned something from an insight into my trading. If you enjoyed the video, drop a like. That helps me out a lot. And make sure you subscribe because I post these videos every week and I don't want you to miss any. So that is all from me today, guys. Thank you for watching and I'll see you in the next video.